This is the second part of lecture series on revision of finance formulas. Let's start with ratio analysis. So there are four kinds of ratios that we're going to cover: liquidity, solvency, profitability, and activity. Let's start with liquidity ratios. The first one is current ratio. So current ratio is current assets upon current liabilities. Let's understand what are current assets and what is involved in current liabilities. The ideal ratio of liquidity current ratio is 2 is to 1. Current assets include inventory or stock, prepaid expenses, cash and bank balances, receivables or debtors, accrued income, short term loans and advances, short term marketable investments. So these are all assets of the enterprise because either you have given them out as loans, either you ought to receive it, because if you have receivables or debtors, that money belongs to you and you have to receive it in the future, or you have some stock or inventory and cash and bank balances. Current liabilities are liabilities or what you have to pay to some other person or enterprise. So these are creditors, short term loans, bank overdraft, cash credit, outstanding expenses, provision for tax, proposed dividend, unclaimed dividend, short term provisions, and advances from customers. So whatever advances you've taken from customers, you have to give it back. So these are all current assets and current liabilities, and this is the formula of current ratio. The next is liquidity asset test or quick or liquidity ratio, asset test ratio. The formula is liquid assets upon current liabilities. The ideal ratio is 1 is to 1. Liquid or quick assets are current assets as calculated above minus stock or inventory and minus prepaid expenses. So this is the formula of quick ratio or asset test ratio. In 2015 and 16, in both the years, current ratio was asked in the exam, so it is one of the most important ones. The next is solvency ratios. The first one is debt to equity ratio, which is debt upon equity, or long term debt funds, because debt here is not short term, it is only long term debt funds. So long term debt funds upon shareholders or proprietors funds or net worth. So equity here means shareholders funds or net worth. The ideal ratio is 2 is to 1. Long term debt funds here means long term loans, that is debentures or bonds and loans from financial institutions. And shareholders or shareholders funds, we are going to talk about in the future. Debt ratio is debt upon total funds. So debt ratio is different from debt equity ratio. In debt equity we are comparing debt and equity. In debt we are comparing debt with total funds that the enterprise has. The ideal ratio is 2 is to 3, or it is also called as debt upon, or all the formula is also debt upon debt plus equity. So debt equity ratio includes only debt and equity, whereas debt ratio is debt upon debt plus equity. This is the difference. Total funds here is shareholders funds plus long term debt. We are going to talk about shareholder funds very soon. The next one is proprietors funds to total funds ratio or equity ratio. So it is equity upon debt plus equity. The ideal is 1 is to 3. Proprietary ratio is another one, which is shareholders funds or net worth or proprietors funds upon total assets. So it is shareholder funds or net worth or proprietary funds, which is the same thing, upon total assets, which is debt plus equity. Shareholder funds or net worth or proprietary funds are, here comes the formula for that: equity share capital, preference share capital, reserves and surplus, minus fictitious assets and losses. So this is the formula for finding out shareholders funds or net worth or proprietary funds. The next one is capital gearing ratio, very important again. The formula is fixed interest and fixed dividend bearing securities upon equity shareholders funds. So fixed interest, these are all liabilities, fixed liabilities that have to be paid to investors. So fixed interest, fixed dividend bearing securities, this is pertaining to preference shares, is equal to preference share capital plus long term debt. So this is what I just said. Fixed asset ratio is another one, which says net fixed assets upon capital employed. We'll be talking about capital employed soon. So it is net fixed assets minus whatever liabilities are there in terms of fixed liabilities. The ideal ratio is less than 1 for fixed assets ratio. The next one is interest coverage ratio. Interest coverage ratio, another very important one. EBIT upon interest expense. Here interest expense is only on long term debt and not on short term debt. You need to remember that. The next one is debt service coverage ratio. Operating income, which is also called as EBIT upon total debt service costs. We'll be covering this soon, total debt service cost. So debt service coverage ratio is EBIT. How to find out EBIT? Another method is this: earning after taxes plus interest on long-term debt. So you're adding back interest in order to arrive at EBIT, plus depreciation, plus other non-cash expenditures like amortization, and you divide it by total debt service costs, which are interest on long-term debt plus installment of principal. So these two combine together to form total debt service costs. Next is profitability ratio. Profitability ratios are the following. First of all, cost of goods sold ratio. Cost of goods sold in 200 upon net sale. How to find out cost of goods sold? The formula is opening stock plus net purchases, that is purchases minus purchase returns, plus direct expenses minus closing stock. Net sales, the formula is total sales minus sales returns. So this is how you come at the COGS ratio. Gross profit ratio or gross margin ratio, another one. The formula is gross profit into 100 upon net sales, wherein gross profit is net sales minus COGS. You have already found out net sales. The next is operating ratio. So operating ratio is COGS or cost of goods sold plus other operating expenses into 100 divided by net sales. You've already found out net sales. We already know how to find out COGS. Let's find out operating expenses. These are office and administrative expenses plus selling and distribution expenses. So you add these expenses to COGS in order to find out operating ratio. Net operating profit ratio. This is different. This is EBIT into 100 upon net sales. EBIT is, you already found out EBIT when we used earning after taxes to come back to EBIT. This is another formula. Gross profit minus other operating expenses gives us earning before interest and taxes. Next is profitability, net profit ratio, which is net profit into 100 upon net sales. This is very easy. Net profit is the profit which is left with the enterprise after all kinds of expenses are taken out. Next is ROCE, return on capital employed. The formula is net operating profits before interest and taxes into 100 upon capital employed. So I had said that we'll be talking about capital employed. Here we are going to talk about capital employed. Net operating profits before interest and taxes is gross profit minus other operating expenses. This is net operating profits before interest and taxes. And the formula for capital employed is equity share capital plus reserves. This is if we are considering the liability side of balance sheet. So equity share capital plus reserves plus preference share capital plus long-term debt minus fictitious assets minus non-trade assets. So this is considering the liability side. If we have the asset side given, then we use this following: net fixed assets, that is fixed assets minus whatever liabilities are there from those fixed assets like depreciation and all those things, plus net working capital. Net working capital is equal to current assets minus current liabilities. So we use this formula, either of these formulas, to find out capital employed. The next is return on equity, ROE. Very important again. Net profit after tax in 200 upon shareholders funds. You already understood how to find out shareholders funds. Net profit after tax is all kinds of profits left after every kind of expenses being paid out to the person or enterprise concerned. Return on total assets. It is net profit after tax again in 200 upon total assets. Not shareholders funds. We have total assets here. Next is efficiency ratios. The first one is inventory turnover ratio, which is COGS or cost of goods sold upon average inventory. You already understood how to find out COGS. Let's see it again. Opening stock plus purchases plus direct expenses minus closing stock, or sales minus gross margin also gives us cost of goods sold. Average stock here is opening stock plus closing stock minus divided by 2. One thing to note here is sales is taken if COGS cannot be determined. So if COGS cannot be determined in a question, only then do you take sales in place of COGS in order to find out inventory turnover ratio. The next is asset turnover ratio. So asset turnover ratio is net sales upon average total assets. It is very easy. Net sales, you understand, sales minus sales return, and average total assets is total assets in the beginning plus total assets in the end divided by 2. It gives you average total assets. Next is account receivable turnover ratio, which is net credit sale upon average accounts receivable. Net credit sale is credit sale minus sales return pertaining to those credit sales gives us net credit sale, and average account receivable is equal to average debtors. So average debtors are opening debtors plus opening bills receivable plus closing debtors plus closing bills receivable divided by 2. Doubtful debtors are not to be deducted from debtors since the purpose is to find out days for which sales are tied up in debtors. So whatever doubtful debtors we have, they are not to be deducted from debtors. The next that we have is creditors turnover ratio. Creditors turnover ratio is net credit purchase upon average payable. So in debtors turnover ratio, we had net credit sale upon average receivable. Here it is otherwise, we are taking into consideration net credit purchases divided by average payables. Average payables are opening creditors plus opening BP or bills payable plus closing creditors plus closing bills payable divided by 2. The next is working capital turnover ratio, which is the formula is net sale upon working capital. Net working capital here is current assets minus current liabilities. So working capital here means net working capital, and you have net sales in the numerator. So let's come to working capital management now. So we have the following formulas for working capital management. Number one, gross working capital. Gross working capital is equal to cash in hand plus cash at bank plus inventory. So these are all current assets. So gross working capital is equal to current assets plus debtors plus bills receivable plus prepaid expenses plus short term investments plus short term loans and advances. So these are all current assets for an enterprise and therefore become part of gross working capital. Net working capital is current assets minus current liabilities. Debtors collection period, how much time does it take for a person or an enterprise to collect money from the debtors? It is debtors into 360 because we have 360 days, approx 365, but we take 360 in order to make our calculations easier upon net credit sale. And if you are considering creditors collection period, then we take creditors and net credit purchases. The next is cash management. We've not talked about this in the course that we have, but let's talk about economic order quantity very briefly. So Baumol's economic order quantity is equal to under root of 2AT by C, where A is annual or monthly cash disbursement, T is fixed cost per transaction, and C is opportunity cost per rupee per annum or per month. And we get economic order quantity using this formula. The next is cash flow statement, how to find out how to make the cash flow statement. Let's understand it very briefly. So we have three divisions: cash flow from operating, cash flow from financing, and cash flow from investing activities. So these are the three parts of a cash flow statement. Operating activities include all those activities which are related to operations of an enterprise. So number one, sales of goods, because this is the primary activity. Royalties, fees and commissions that an enterprise gets from its primary activities. Less payments to suppliers, whatever payment is made for raw material, payment to employees for work, payment for factory, office and selling expenses. So this all forms part of operating activities. Then next comes cash flow from investing activities. So whatever investments the enterprise is making in the long term become a part of investing activities. Sale of fixed assets. So you get money when you sell fixed assets, therefore it's a cash inflow and therefore it is added in cash flow statement. Next is purchase of fixed assets. When you're purchasing a fixed asset, you are paying out money, and when you're paying out money, and therefore it is reduced from cash flow statement. Next is investments in shares, debt instruments, etc. Whatever investments you have made. And next is loans made to a third party. So you're again paying out money. Your money is going out of the enterprise in terms of cash, and therefore it is reduced from cash flow statement. Next is cash flow from financing activities. The elements here are issue of shares, debentures, loans, etc. And you reduce long-term borrowings, cash repaid, whatever repayments are made in terms of long-term borrowings. Redemption of debentures, you're again paying back debenture holders. Next, interest paid and dividend and corporate dividend tax paid. So these are all payments in terms of financing activities. So this is all about finance practical formulas that are important for the exam this year. I hope you are able to revise properly using these formulas.